Creation and interpretation of financial forecasts. A financial forecast is an estimate of a business's future financial performance based on historical data, current trends, and informed assumptions. They are used for planning, budgeting, setting targets, attracting investment, and supporting decision-making within a business. The different types of financial forecasts are sales forecasts, cash flow forecasts, break-even forecasts, income statements, and statements of financial position. Sales forecast. A sales forecast is a prediction of the future level of sales revenue or unit sold over a specific period of time. A sales forecast is made by analyzing past sales data to identify trends, patterns, and seasonal variations, then combining this information with market research and knowledge of customer behavior. Businesses also consider factors such as pricing strategies, promotional activities, competitor actions, and wider economic conditions, where assumptions are formed about how these elements may affect future demand. These estimates are then calculated to produce projected sales figures for a set period. A sales forecast is used to predict sales by providing expected revenue or unit figures that guide business planning and operational decisions. Managers use these projections to determine production levels, staffing requirements, and stock control, ensuring that resources are allocated efficiently. The forecast also supports the preparation of other financial documents, such as cash flow forecasts and income statements, helping the business anticipate performance and prepare for potential changes in demand. Cash flow forecasts. A cash flow forecast is an estimate of the cash inflows and cash outflows of a business over a specific period of time. A cash flow forecast is made by estimating all expected cash inflows, such as sales revenue, loans, and investment, and all expected cash outflows, such as wages, rent, suppliers, and other expenses, over a set time period. These figures are then organized month by month to calculate the net cash flow and the closing balance for each period. The forecast is based on assumptions drawn from past data, planned activities, and expected changes in the business environment. A cash flow forecast is used to predict consequences by showing periods where cash surpluses or cash deficits may occur, allowing the business to anticipate potential liquidity problems. If a negative closing balance is predicted, this highlights the risk of being unable to meet financial obligations such as paying suppliers or employees. As well as this, predicted surpluses may indicate opportunities for expansion or investment. A cash flow forecast is used to suggest and justify solutions by identifying specific periods where financial difficulties are likely to arise and evaluating the impact of different actions. For example, the business may decide to arrange an overdraft, delay certain expenditures, reduce costs, or attempt to increase sales through promotions. By adjusting the forecast to reflect these proposed changes, managers can assess whether the solutions are likely to improve the cash position and support informed decision-making. Break-even chart. A break-even chart is a graphical representation that shows the relationship between costs, revenue, and output, identifying the level of sales where total revenue equals total costs. A break-even chart is made by first calculating fixed costs, variable costs per unit, and selling price per unit, then plotting fixed costs as a horizontal line on a graph. Total costs are drawn by adding variable costs to fixed costs at different output levels, while total revenue is plotted by multiplying selling price by quantity sold. The point where the total revenue line intersects the total cost line represents the break-even point. A break-even chart is used to predict consequences by showing the level of output required to avoid making a loss and illustrating the potential profit or loss at different sales volumes. If predicted sales fall below the break-even point, the business can anticipate losses, whereas sales above this point indicate potential profit. This enables managers to understand the financial impact of changes in price, costs, or demand. A break-even chart is used to justify solutions by allowing managers to model changes such as reducing fixed costs, lowering variable costs, or increasing the selling price to see how these adjustments affect the break-even point. By comparing different scenarios, the business can identify strategies that reduce risk or increase profitability. The visual nature of the chart helps justify decisions by clearly demonstrating their financial impact. Income statement. An income statement is a financial document that summarizes a business's revenue, costs, and profit or loss over a specific accounting period. An income statement is made by recording total revenue for the period and then deducting the cost of sales to calculate gross profit. Operating expenses, such as wages, rent and utilities, are then subtracted from gross profit to determine operating profit, and any interest or tax is deducted to arrive at net profit. The figures are usually drawn from accounting records and organized in a structured format to show each stage of profit calculation. An income statement is used to predict consequences by analyzing trends in revenue, costs, and profit over time to identify areas of strength or concern. If profits are falling due to rising expenses or declining sales, the business can anticipate financial difficulties and reduced retained earnings. Strong and consistent profits, however, may indicate stability and the potential for growth or investment. An income statement is used to justify solutions by highlighting specific cost areas where reductions could improve profitability or revenue streams where growth strategies may be effective. Managers can use the data to support decisions such as cutting unnecessary expenses, increasing prices, or investing in marketing to boost sales. The clear presentation of financial performance provides evidence to stakeholders that proposed actions are necessary and financially sound. Statement of financial position. A statement of financial position is a financial document that shows a business's assets, liabilities, and capital at a specific point in time. A statement of financial position is made by listing all non-current and current assets, then listing all current and non-current liabilities, using information drawn from the business's accounting records. The total value of liabilities is subtracted from the total value of assets to calculate capital, ensuring that the accounting equation balances. The figures are organized in a clear structure to present the overall financial position of the business at the end of an accounting period. A statement of financial position is used to predict consequences by analyzing the levels of assets and liabilities to assess liquidity, solvency, and financial stability. If liabilities are high compared to assets, the business may face difficulties meeting its long-term obligations or securing additional finance. Strong asset levels and manageable debt, however, may indicate financial security and the capacity for expansion. A statement of financial position is used to justify solutions by identifying weaknesses such as low current assets or excessive borrowing and supporting decisions to improve the financial structure. Managers may decide to reduce debt, sell non-essential assets, or seek additional investment to strengthen liquidity. The documented evidence of the business's financial position provides justification for these strategic changes to stakeholders. Thank you for watching this video on creation and interpretation of financial forecasts. I'll see you in the next one.